Good afternoon, everybody. I am Ambassador Doug Silverman. I'm the new president of the Arab Gulf States Institute in Washington, and I'm very happy to invite you here, to welcome you here to AGSIW this afternoon to talk about a very interesting topic, the desire and the struggle of Gulf states to diversify and modernize their economies. I'm here to give a brief introduction, but want to turn the floor quickly over to one of our scholars at AGSIW, Robert Mogielnicki, who will provide introductory remarks and moderate the conversation. So, Robert, please go ahead.
All right. Thank you very much, Doug. And thank you, everyone, for joining us today. And I hope you had a good holiday weekend and stayed as dry as possible yesterday with the rain that we had. And, of course, thank you very much for joining us today for what we hope will be a very interesting event. Economic diversification is certainly not as sensational of a topic as tankers being attacked in the Gulf of Oman, but I think the topic's resilience in policy circles and the academic spheres over the past few decades is really a testament to its relevance and its continued relevance. Just the other day, the Oxford Institute for Energy Studies produced a 50 or 60-page report talking about economic diversification in the MENA region, and we saw a lot of the familiar concepts being mentioned again and again, concepts about sustainability, economic transformation, prioritization of economic reforms. And the Gulf Arab states are well accustomed with these debates about economic diversification. All of their respective economic strategies talk about weaning their economies off of an overdependence on hydrocarbon revenues. And indeed, after the oil price drop in 2014 and the subsequent volatility in oil markets, we saw a renewed interest in economic diversification agendas. But then, if you fast forward a couple of years later, in 2018 and 2019, if we looked at Gulf governments and their budgets that they proposed, we saw a reinstitution of generous government handouts. So I think this leaves us with a kind of uncertainty when we look ahead at what the future is for economic diversification in the Gulf. I don't think that any of the Gulf Arab states have stumbled upon a recipe for success. Mark Twain noted that you don't put all of your eggs in one basket because then you're going to scatter your money and your attention. But really what you should do is put all of your eggs in one basket and watch that basket really closely. This is an oversimplification, but I think it illustrates some of the strategies that local policymakers are grappling with. On the one hand, we see development of new industries and investments in global technology firms. On the other hand, there's continuing to be more money poured into petrochemicals, renewables, refineries, energy parks. So joining us today are two individuals who I think are very well suited to help us make sense of some of these trade-offs here. Also to take a look at the current state of economic diversification in the region and perhaps give us a vision for what the future holds. To my right, Sona Varma is a lead economist for the Gulf Cooperation Council countries at the World Bank. She works on macro, trade, and investment global practice at the bank, and she supports GCC clients on macro, fiscal, and growth-related issues. She's worked previously across the globe in Africa, in South Asia, and the Caribbean, and holds a PhD in economics from nearby American University here in Washington, D.C. A little bit farther afield here, and joining us from Dubai via London is Ziad Daoud. He's Chief Middle East Economist for Bloomberg Economics. Prior to joining Bloomberg in 2017, he was head of economics at QNB Group and led a team that produced analysis on the Middle East and the global economy. He holds a PhD in economics from the London School of Economics. So what I wanted to do from the outset is give both Sona and Ziad an opportunity to make some initial remarks. I've asked them to prepare about 10 to 15 minutes. And I'm going to start with Sona and ask her to take a bit of a macro approach to the topic. And we know that prioritization of economic reforms is really crucial when we're looking at economies undergoing substantial transformation. So I wanted to ask what, in your view, you believe the policy priorities to be when we're looking at economic diversification efforts in the Gulf. It's a tall order, but I'll turn it over to you to start things off.
Thank you. Thanks, Robert. The World Bank, many of you know the World Bank. We are primarily a lender to middle-income and low-income countries. But in the GCC, we have a different relationship. We provide fee-based advisory services to our clients and have a large program across the six GCC. We have staff in Riyadh, in Kuwait, and now in Abu Dhabi working on the program, and a very large contingent of us here in Washington, where I'm based, supporting our clients. So that is the perspective from which I come, from which I have had most of my learnings on the GCC. Recently, we have done a lot of work on the issue of growth and diversification, especially in Saudi Arabia. So I'll use some of that to give you a little bit of sense of where I come on this topic of diversification, which is really, like Robert said, there's no recipe for it. There are no rules for it. It's really a mixture of good policies and a lot of good luck. And it's not by any means a topic that these countries have not been talking about for decades, right? We've heard about diversification issues since the first oil price shocks many, many years ago. So let me talk to you about a couple of things. And the main message I want to communicate, Robert asked, what are the policy priorities? Let's go into that. But the big message that I want to leave you with is that in order to be successful, countries in the GCC will really have to rethink diversification, use a new approach, an approach that moves them away in a very strong fashion from the oil-based diversification that many of them have been doing towards a diversification policy that really focuses on growing the non-oil private sector in these economies. They've made progress on this in many fronts, and we'll talk about it. But in order to make this point better, let me structure my remarks in three categories. I'll talk first about the global context of why I think this is important. Secondly, we'll go into the meat of what Robert wants me to talk about. What are the policy priorities? I'll briefly mention three, and then we can have more Q&A on that. And then I'll talk a little bit about the trade-offs that I see these countries grappling with. And I don't have answers, but I think it's important to recognize the real challenges that they face. So firstly, on the global context, the first big issue I want to talk about is the issue of slowing global growth. I think Ziad will talk about this a bit. I'm sure he's better placed than me to talk about all the vagaries of what's happening in global growth. But I think it's becoming clear that China is slowing down. India's growth has not been as robust as we thought. The UK is facing issues with Brexit, and Europe growth is slowing. So these countries, in their most recent initiatives to diversify, are facing headwinds in terms of global markets. As they try to grow their non-oil commodity exports, they're going to face a softening of demand. So this is one issue. But this, to me, is not the main issue. The main long-term issue and challenge and global context that these countries want to think about is what we've, again, discussed for decades, but is becoming more and more important today, and that is the relevance and the long-term sustainability of an oil-based economy. Most of these countries still are primarily based on oil, as we've discussed. It's becoming clear that now the global megatrends are pointing to possibly, a real point in the next couple of decades where we will have to rethink the role of oil in the world, right? This is happening both because of climate change. It's also happening because of technological disruption. As electronic vehicles and cars and batteries become more easily produced, as renewable energy becomes more important, you're going to face a situation where oil is going to see question marks on what is its role, what is its value in society, what is its relevance. So these are the two big global megatrends I wanted to talk about. Firstly, the issue of low growth, and secondly, the much more important issue of the low-carbon transition, as it's well known across most circles. So what does that mean for diversification in the Gulf region? It means, like I said in the beginning, a switch from their current thinking of what many countries have been doing, and I'm thinking Saudi in particular because that's what I've looked at more carefully, from the current trends of traditional diversification, which is diversification across the oil value chain, to one where you're looking at different sectors, different capabilities, different know-how, different markets. And that's a massive shift. It's begun to happen. We've already seen in the GCC exports going to countries outside of the GCC, and I'm talking about non-oil exports. You've seen industries like tourism and transport and financial services do well in countries like Bahrain and Oman, for example. So it's happening, but you need a massive shift away from oil and towards these new sectors, knowledge-based economies, economies that are not linked with oil. So what then are the policy priorities? And this really we learned a lot by doing work on diversification in Saudi. So a lot of what I'm saying applies there, but I think it also applies in many ways to the other GCC countries. There are three priorities I want to highlight. The first is the priority of a strong and attractive climate for private investors. Most of investment in these countries has been public sector driven, and we can go into those details later. But what you want is an investment climate that is conducive to private sector investment. What does that mean? It means ease of entry of businesses, ease of exit through insolvency and resolving insolvency type of laws. You already see some of that, but that's one area where you want to see, clear improvements on the ground. It means competition policy, because right now I would argue that the decks are still stacked in favor of the public sector. It means a flexible labor market policy, and I'll get to that in a minute. 3 or 4 things like that really would improve the investment environment. Now, if you look at the doing business rankings of the World Bank, most of the GCC are doing okay. In fact, I think the UAE was number 11 ranked, so it's doing actually well. But there's much more to the investment climate than what is captured in many of these rankings, whether it's the banks doing business or the global competitive ranking or other such rankings. So it's really what happens on the ground in terms of incentivizing private sector companies to invest outside of the oil space and invest without government contracts or government handouts. So that's what I'm talking about in terms of business investment or business environment. The other big policy priority is the need to strengthen human capital. Again, I don't think we can say, in any way that you don't have strong educational outcomes in the GCC. Most of the countries, in terms of years of schooling, score very well. Many of the GCC nationals are coming abroad to get degrees. So you have the skills, both with men and women. What we are seeing, for example, with our human capital index, and some of you may have seen the World Bank's human capital index, is that while you have the traditional markers in terms of years of schooling and primary school enrollment, what you don't have are learning outcomes that are commensurate with what you're seeing in the peer countries that the GCC is usually compared with. For example, if you look at the World Bank's human capital index that we published last year, the estimates that we see show that if you adjust for learning, the years of schooling in the GCC are 7.6 years in Kuwait instead of the 12 to 13 that you should see, 8.1 in Saudi, and 9.6 in Bahrain, for example. And this, I would argue, is a key factor that's affecting human capital building in the GCC, despite the fact that you do have some headline indicators that show that you have a well-educated workforce. And the third one, which I alluded to in the beginning, was the need to have flexible labor markets. While Gulf countries have been pursuing policies to increase the share of nationals in the workforce, unemployment is still high. Saudi unemployment is at 12.5% currently, with unemployment rates for women and youth being even higher. And there's a good reason for this, right? For years, the countries have had a divided labor market, with expats doing some part of the work, and mostly in the private sector, and nationals holding pretty much guaranteed jobs in the public sector. Those public sector jobs, in return, have created a very high reservation wage, which makes private sector work less attractive, just to be very sort of general at this point. So what we are seeing is a country where I would argue, more than diversification, employment is a big objective. When I look at the Saudi vision and some of the other vision-related documents in the GCC, it's really about creating jobs for the very large workforce that is coming on stream, and now highly and more increasingly educated. So with the kind of labor market you have today, that is going to be difficult to do. So those are the three key policy priorities I want to highlight. There's plenty more, and I thought we can talk about them when we get into the discussion session of this event. So finally, what are the two key trade-offs that I'm seeing? Or actually, again, many trade-offs, but two key ones that I want to highlight. The first one, coming from what I mentioned in the policy priorities, is a big trade-off between the labor market policies to get employment for nationals and increasing competitiveness of the private sector. So if you agree with me that the real turnaround and diversification will come when you have more private sector firms that are competitive in the region, to constrain them with labor market policies that require quotas and minimum wages, et cetera, is going to be difficult. Now, this is not an easy situation to deal with. On one hand, there's a real need for employment. On the other hand, you want to offer firms the flexibility to hire and to make the best choices. So this to me, is a big trade-off that all these countries are dealing with. The second one is, what is the role of the state in managing this transition? While the objective of most of these vision plans is to increase private sector-led growth, the reality is that most of the growth in the region is still public sector-led. The public sector will have to create an environment where it's not competing with these nascent and new firms in the private sector. We'll have to have some degree of transparency, which lay down some ground rules of where public sector participates and where private sector can come in. There will be, we will need some policies to reduce excessive monopoly rents in the non-tradable sector. For example, public sector investment funds like the PIF in Saudi Arabia could probably act as a venture capitalist, investing in some of the more innovative yet risky businesses and giving them support. So this big transition is also something that is quite challenging and the Gulf countries are dealing with on a daily basis. Let me stop there. I think in conclusion, what I want to say is that we've seen in our discussions and dialogue and support of the GCC countries tremendous commitment at the highest levels in all of these countries in order to pursue diversification. But then the devil lies in the details, and that's what we're hoping you can work through with a little bit of luck and perseverance. Let me stop there.
Great, thank you very much. I'm going to turn it over now to Ziad. I'd asked Ziad to give a bit more of a granular view of economic diversification as it's playing out in particular countries, with a focus on Saudi Arabia, but also to the degree that you can in the short time, touching on other countries as well.
Well, thank you, Rob, for the invitation to speak here and for the Institute for hosting this event on this very interesting topic. So to answer Rob's question, what I'm going to do in the next 10 minutes is I'm going to talk about the progress and diversification drive that we're seeing in the GCC. Unfortunately, I'll be mostly focusing on Saudi Arabia as the biggest, most important country in the GCC, and it's also the one which has the most visible diversification sort of program, Vision 2030. But essentially, a lot of the stuff I'll be saying about Saudi will apply to all the other 5 GCC countries, almost one for one. And also I'll be echoing a lot of the stuff that Sona has been talking about. So there will be an overlap and an agreement, thank goodness. So before talking about diversification, let me just talk about dependency on oil. If you go to the region, you might see people in the region saying, look, If you look at the share of oil in GDP, today is 40% roughly. That's Saudi Arabia, but also similar in other countries. It used to be 60% only a few years ago. Therefore, we're becoming more diversified. And I think that's partly misleading. It's misleading because the decline in oil share in the economy has happened because oil prices have declined over the last few years. At the extreme, if oil prices go to zero, the share of oil in GDP is going to be zero. But that's not the type of diversification you want to have. And it's also misleading because the non-oil economy is not completely independent of oil. A lot of the non-oil activities are funded by oil money. Think construction, think government services, think services in general. And when oil prices drop, these sectors do experience a slump, as we're currently seeing in some sectors in the GCC. So a better metric for diversification is to look at the share of oil in government revenue and the share of oil in exports. And there, oil is very dominant. In Saudi Arabia, despite recent efforts to increase non-oil revenue, oil is about 2/3 of government's revenue, and it's 80% of exports. And again, the picture is similar in of the other 5 GCC countries. Now, there's always been talks and hopes of diversification in the Gulf. But I think the slump in oil prices in mid-2014 was a reality check. The region did have visions and strategies and 5-year strategies and plan to diversify, but it was very difficult to execute this. The incentives were low when oil prices were above $100 per barrel for 4 consecutive years before 2014. And then you had the slump in oil prices in 2014, the big drop. And that was a reality check. We've seen more urgency, new initiatives, nowhere more visible than Saudi Arabia with this Vision 2030. So it unveiled Vision 2030, which is basically, it's an aspiration of where Saudi policymakers want the economy, want the country to be by 2030. And central to that vision is the idea of having a diversified economy that's less dependent on oil. Now, how do we assess that initiative 3 years on? Well, it's difficult to assess Vision 2030 because the targets are so far away. We're so far away from the destination that it's just difficult to, have a progress report. But with the vision, there was another program, something called the National Transformation Program, that Saudi published in 2016 and updated last year. But in 2016, they actually outlined a set of targets for 2020, so intermediate targets en route to 2030. So maybe, now we're less than 6 months away from 2020. It's a good time to actually look at that document, see where they aspire to be, and see where we currently stand. And this is what I try to do basically here. So in the National Transformation Program document, I just looked at some of the economic targets that they had in the document. There's a lot of targets, something about, how often people should be working out, how healthy the population is. But I'm focusing only on the economic targets. There's about 8 or 9 targets here, and I split them into 3 different sort of categories. But what we see is something sort of, the outcome is something quite visible. One is there has been some progress on the fiscal side. So we've seen them cutting spending, we've seen non-oil revenue increasing. We've seen actually one good thing that Saudi did, maybe less so for the rest, is they started disclosing more data. The budget document today is more hefty in Saudi Arabia than it used to be a few years ago. They publish quarterly, fiscal numbers, which they didn't used to before 2017. They publish a pre-budget statement in September. They did that last year. So there's more disclosure now, so you have to give them credit for. But on the fiscal side, there has been some improvement, maybe not to the extent that is in line with the National Transformation Program target, but there is some progress on that. Now, on the targets which are related to diversification, making the economy more competitive and more dynamic, unfortunately, things have gone backwards. So you look at foreign direct investment, for example. The baseline, which is where foreign direct investment was in Saudi Arabia when they did the National Transformation Program, was 30 billion Saudi riyal. I think it was 2015 or 16. The target was to hit 70 billion Saudi riyal by 2020. Last year, FDI was 12, so it went actually down. If you look at the World Bank's ranking of ease of doing business in Saudi Arabia, they used to be at 82. They were targeting to be in the top 20. and they regressed to 92 last year. If you look at the Global Competitiveness Index ranking, they used to be, they were at 25, they were hoping to climb up to 20, but then they went backward to 39. So on the stuff that makes the economy more diversified and more competitive and more dynamic, there hasn't been much progress on that. And the third category is the labor market. And there the picture is more mixed. So, for example, on the proportion of female in the labor force, more female participation, that did actually improve in the last couple of quarters. So they're making, progress relative to where they were. And a decision, for example, to allow women to drive is helpful in that respect. But the unemployment target, for example, has gone up. Unemployment did go up. So they started with 11.6% unemployment. They were targeting 9%. And today, unemployment rate in Saudi Arabia is 12.5% among the Saudi nationals. So the picture is more mixed on the labor market. So the overall progress is fiscal progress, although in the last couple of years, the urgency to balance the books appeared to have waned. There's little progress on the diversification front. On the labor market, the picture is more mixed. Now, there are different routes to do diversification. One of them is to pick sectors, but another one is just to go and ask people, what is preventing you as a Saudi business from exporting to Jordan, to Egypt, to India, or to Europe? What is preventing you as an Omani company from doing the same? And you could just look at the list of complaints that people talk about, the list of hurdles that people mention, and try and address them. And actually, the World Economic Forum does exactly that. It's actually a very good survey from the World Economic Forum. It goes and picks for each country. It asks the executives, what are the biggest hurdles of doing business in your country? And what I have here is the average results for the 6 GCC countries. So not only Saudi, but all of them. And one thing is fairly clear here, that the labor market is very problematic. Again, a point that Sona mentioned. The 3 of the top 5 complaints are related to the labor market. The first one is restrictive labor regulations. The third one is the inability to find adequately educated workforce. And the fifth one is poor work ethic among national population. So there is something, that requires addressing in the labor market. And if you do that, I think you'll go a long way towards creating a competitive and more diversified economy. Have we seen initiatives to address this? Some yes, sometimes yes, sometimes no. So, for example, one initiative is allowing women to drive would help create a bigger pool of labor that is, able to find jobs. We've seen initiatives in Saudi Arabia, in the UAE, and in Qatar to allow expatriates who, make up a significant portion of the population to have long-term residency. That is helpful as well. But we've also seen steps or initiatives that makes the labor market more segregated and more regulated. We've seen higher nationalization ratios across the GCC countries. Have Qatarization in Qatar, Emiratization in the UAE, and Saudization in Saudi, and that initiative is becoming stronger. You're seeing in Saudi Arabia the imposition of a levy on expatriate workers. That makes the labor market more regulated and more restrictive. And that's an issue. And the labor market is key not only because it's just instrumental to everything, but it's at the heart of the social contract. And that's why it's difficult to address this. And that's why it's difficult. Well, if you make changes there, they'll go a long way. Now, let me just conclude with one thing, because what we've noticed in the region the last year or two is with the stabilization of oil prices, the reform sort of initiatives have waned. We've seen expansionary budgets, even where you have made progress on the fiscal side, we've seen the budgets becoming more expansionary. There were plans to, for example, remove another round of fuel subsidy removal, and that hasn't materialized yet this year. It was in the budget of Saudi. It hasn't happened yet. And it seems that the old model of growth, with big government intervention fueled by oil money is creeping back in. And that is dangerous. And it's dangerous because, we're 2019, which is very different from 2014. The balance sheet of GCC countries as a whole is weaker today than it was in 2014. The savings are lower. Saudi foreign exchange reserves are down by a third since 2014. Debt is higher. Oman's public debt has gone up tenfold since 2014, from 5% of GDP to 50% of GDP. Qatar's external borrowing has nearly doubled since 2014. So the balance sheet is weaker, and the ability to absorb any shock that comes to these economies, whether it's from oil, from geopolitics, or from the global economy, is weaker. And the best case scenario, if you get a negative shock, is another fiscal retrenchment, another cut to spending, and new taxes being added, and another decline, sharp decline in economic activity. And bear in mind, a lot of these countries have not yet fully recovered from the oil price shock of 2014. And that's the best case scenario in case if you get a negative shock. The worst case scenario is you get a shock that is so, a decline in oil prices that is so sharp and so persistent that it could destabilize the economies by threatening the currency peg. And that's destabilizing because not only does it impact the weak economies in the GCC, but it could spill over to the stronger ones in the region. I think on that very happy note, I'll stop here and maybe hand over to Rob for Q&A.
All right. Well, I said I would reserve one question to kick things off. So, as briefly, if both of you touched on the private sector and the role of the private sector in economic diversification initiatives here. And we hear regularly that for economic diversification to be sustainable, it needs to be led by the private sector. I guess I want to ask both of you, how realistic is this, given the state-led development history in the GCC? And also, is this challenge, is it a technical challenge or is it a political challenge? Or is it both?
Okay. Well, let me attempt. It's a tough question and probably one of the most important questions that these countries are dealing with, especially in Saudi. In the Vision 2030, Saudi Arabia has an explicit goal that it wants 65% of its GDP to be produced by the private sector by 2030. And they are interpreting that goal in many ways through these transformation programs, trying to figure out how they can do this. And all the rankings that Ziad showed, they're working at a very micro level to try to improve every indicator behind those rankings. So is it realistic? I think it's realistic depending on the ambitiousness and the ambition of the policies that they undertake. And I see more and more of a desire to do this. It's going to be very difficult given the massive overhang of the state in the economy. So I think this is certainly the main way that they're going to be trying to change their economy around. And without this, they're not going to see diversification the way we understand it and the way they would like to see it, and a real delinking with the volatility of oil. But I think for Saudi, what I've seen is certainly a lot of commitment to try to turn this around.
Well, I think the thinking behind having a bigger role for the private sector is the fact that if you look at these economies, you typically see a private sector that is productive and a public sector that is less productive. And the thinking goes that if I make the share of the productive sector of the economy bigger, then the economy as a whole will become more productive. And that is fair. But then you need to make sure that as you're growing that productive side of the economy, you're not impacting its productivity. International experience tells us that there's no single route to development. You could do a state-led model, or you could do a private sector-led model. The issue is. The concern is you don't want to have a bigger role for the private sector and yet make it more unproductive, and then the overall economy will suffer as a result. An alternative, path is to have a bigger role for the state, but as long as the state has a productive sort of business model, which one I think either route could be fine. But in order to do this, I think you need to address the micro issues, which are related to the labor market, which are related to the local monopolies, and making the economy more competitive and open. And you could do that with the private sector or with the public sector. So yeah, I'm more agnostic on this than is given.
All right, we're going to turn it over to the audience now. So I hope you came prepared with plenty of questions. Doug will to kick things off here.
Thank you very much for your very good presentations on some of the micro and macro obstacles toward economic diversification in the Gulf. I'm always an optimistic guy, a glass half full guy. What has worked thus far in government programs? Are there any sectors, are there any particular programs, projects, things that have begun to work that could be replicated elsewhere? Or where do you see in all of these charts and in all the goals the greatest chance of near-term and medium-term success?
That's a difficult question. I think okay. So I think the root of the problem is you have a social contract you have a social contract where it distributes the oil money between the states and the citizens, and part of it, and it hits the labor market and it hits everything, and that's what creates the inefficiencies in the economy, and that's what prevents diversification. I think where you see a model of one possible route for escaping is and it's difficult to change that because it's a political decision as opposed to an economic one. So you have to be able to bear the political consequences of that. I think where you've seen a model of success is the concept of free zones. So the idea is, if I can't change the labor laws across the land, let me create pockets where firms can set up shop for free, not for free, can set up shop where foreign investors can come in and have 100% ownership of their companies, where they could come in and they don't have nationalization ratios in the labor market. And there's plenty of them now in the GCC. Dubai is full of them. I work in one, which is the Dubai International Financial Center. And my firm, Bloomberg, has set up shop there. And that's sort of, the idea seems to have worked, where you have pockets of productivity, of foreign direct investment going in, and yet you're protecting the social contract sort of outside it. The issue with that model is scalability. You could do that on a small scale, but eventually, if you want that to, apply to the country as a whole, at some point you have to address the difficult questions that are related to the labor market and local monopolies and so on. But I think the free zones is sort of a good starting point, a safe experiment to take and undertake, and then see how far you could push that. And I think there's a realization in the region that there's actually a decent model. So we're seeing free zones popping up across the region. And apparently there's one, the big one in Saudi Arabia, Neom, is supposed to be a free zone as well, but on a very large scale.
Yeah. Let me just supplement that. I think the biggest chance for success are in stroke of the pen reforms. When I look at Saudi and I look at my own home country, India, you try to make the smallest change and some vested interest is going to pull that government down. That's not necessarily the case in the Gulf, right? So I think in terms of the framework for competition, the framework for investment, whether you do it through free zones or you do it through a broader reform of the regulatory structure, I see that as being the most sort of demonstrative of the reforms. And also, what I feel that the governments are working very hard on in terms of bringing their legislation and regulation up to global standards as far as they can. That's certainly the short run and the quick wins that they can have. The broader issues are much more intractable, and we can talk about that.
And I would just mention, too, and if we're looking at non-oil revenues for the government, we obviously had the VAT, which was introduced in 2018, and now we're starting to see some of the figures and the role that value-added tax has played in government budgets. Saudi Arabia, I believe, it was about 1.6% of GDP, around $12.5 billion. Now, that's great in terms of raising non-oil revenues, but on the other hand, the government also extended generous government handouts that they had initiated in 2018, in 2019, and they equated to just over $10 billion. So we see a step forward and also a step back in many cases when we're looking at some of these policy measures. Yeah, right here in the front.
Hi, thank you so much for the presentation. I want to ask about Gulf investments, but especially Saudi Arabia's investments in Silicon Valley and technology, because I was wondering if that really is a sustainable strategy or move for them, considering how volatile tech companies can be. I mean, we see this in the light of Uber's IPO, for example. And then also, how can Gulf states move toward building the technology sector without recreating or exacerbating some of the social stratification and wealth gaps in their societies?
Now, in terms of the public investment funds investments in the tech sector, well, obviously it depends on the share, and if they're investing a small amount of their portfolio in a volatile company, then it's perfectly fine. I think the idea of creating a sovereign wealth fund in Saudi was well overdue. You've seen it in the other parts of the region where they had their savings in investment vehicles, sovereign wealth funds. You see that in Abu Dhabi, you saw that in Kuwait, you saw that in Qatar. There was no point just leaving all these huge savings as cash at the central bank earning very little interest. And it just made sense to have long-term investments, both outside the country, but also inside it to create new development sectors. So again, we don't know the shares and how much they're investing in these tech companies. And it could be a viable investment strategy. It could be not. I mean, I'm not the person to judge.
My only comment is I see this in the nature of the high risk, high return type of investments that, if the government and the state is going to make, this is where they can viably try this. And it's also their way of trying to hedge against oil, right? So yes, you're right, tech is volatile, but it may give them a hedge from oil volatility.
Great. Yes.
Thank you. Can you just comment on the peg currencies, which are fairly unusual these days after 1998? Why is this? What's the reason to keep the peg? Are they afraid of the economic disruptions or the political disruptions that would occur?
I think the pegs make sense, and it makes sense because of this picture. 80% of your exports are oil. Oil is denominated in dollars. It makes so let's just think about let's just think about the world where there's no peg. Oil prices dropped in 2014. The currency would have dropped massively. It did drop even in economies whose countries, countries where the economies were diversified. Norway, Canada. You live in the Gulf. Your currency drops by 20 or 30%. A lot of your, the stuff that you consume over there is imported. Inflation will go up very quickly and very high, and it's not going to be just going up. It's going to be very volatile as oil prices. And if the objective of macroeconomic policy is to stabilize inflation and output, then that's definitely not a good way to do it. The other issue is with countries with more diversified export structure, like Canada, like Russia, like Norway. If the currency drops, yes, you're getting more inflation, you're hurting consumers through higher prices, but also your exporters benefit from the decline in the currency because they gain competitiveness. That doesn't apply to the GCC. What you export is oil, is denominated in dollars. A drop in the value of the currency is not going to make a Saudi barrel of oil more competitive than a Russian one. So you get all the negatives of a decline in the currency without the export support that you get from the currency. So I think at this stage, given the structure of your exports, I think it makes sense to have a currency peg, but clearly disagree with me. So
the contrast with Russia was pretty stark, which is also almost as dependent on oil and gas. And they let their currency depreciate massively, and they came through this a lot better. There's other parallels that don't work, but that's clearly.
I'm not sure if Russia. Well, sorry, I'm not sure if Russia is dependent on oil as the GCC. The other problem with the Gulf, still, it's not. I don't think it's as dependent on Saudi Arabia. But the other problem with the Gulf in general, if you look at, so I talked about inflation and the impact on inflation. If you're going to attract FDI, if you want to attract foreign labor, which 90% of the population in Qatar and the UAE is expatriates. Mm-hmm. If you're going to tell them you're going to be paid in a currency that's as volatile as oil prices, good luck attracting them. I'm not going to work there if the currency is going to be as volatile as oil. It makes it easier to attract people, to tell them, look, your currency, you're going to be paid in local currency, and that's pegged to the dollar. You know exactly how much you're getting paid in dollar. You're coming as a foreign investor. You know exactly how, you know your return is going to be in dollars. You don't have the exchange rate risk. You have other risks to deal with. So I think if you're going to attract labor and capital, actually it makes sense for the GCs, and them far more reliant than any country in the world on foreign labor. It makes sense to have a currency peg. Now, there is a counter argument that says you don't have non-oil exports because, currencies are linked to the dollar. Dollar is appreciating. You're already uncompetitive. These sectors are never going to materialize. But I think at this stage, if you're going to depeg your currency or devalue it, do it from a position of strength, not now. When oil prices recover and people think that you're doing it as of, from a position of strength, it makes sense to do it then. You do it now, and speculation will be just rife.
Just follow up on the question.
Of course.
It's the same. How about pegging? Yeah. The peg, how about the peg to a basket, currency and commodity? You do the dollar as well as oil in your pegging.
That's what Kuwait does. So Kuwait has a peg to a basket, but the basket will be dominated by dollars because the main export is
So the commodity, oil and dollar. So when you oil price volatility and you have dollar valuation and the combined effect.
So the currency would be linked to oil.
Oil
And it's a basket of
Yeah, but that'll make it more volatile still. How does...
These are the two main.
Right.
So if oil prices drop, the currency would what? Drop as well.
Depreciate.
Yeah.
Depreciate.
Again, it depends on the weight. If you do that 1%, then it's okay. It's an almost peg. If you do that 30%, then you don't want your currency to be volatile as volatile as oil prices, because inflation is going to be as volatile as oil prices, and then your incomes are going to be volatile as oil prices.
So,
Sonia, would you like to
yeah.
add here?
So just to add to that, this has been a debate, and I've discussed with the IMF, for example, for years. Why is it that these currency regimes persist? And they actually don't persist only in the Gulf. They persist in West Africa. They persist in the little ECCB, the Eastern Caribbean countries, which have had a 30-year peg despite the vagaries of their economic situation. So the main thing that I've understood why countries do this is something that Ziad also said: predictability and transparency, and stability. So when those things are important in order to make sure, for example, that if you have a big expat population, they know what their remittances are going to be. If you're attracting FDI, they know what their returns are going to be. That predictability is something that many central banks prioritize in a big way. The stability that comes from the exchange rate peg is another big priority. Where could it hurt? And again, the empirical work that we did in the context of the Saudi study was not very conclusive. But where it could hurt is as these countries are trying to enter new export markets, new countries, new products. So there they need to basically put their best competitive foot forward. And then if the exchange rate is hampering them, they need to compensate in other ways. In the Saudi study, we found that, more than the peg, it was the energy subsidies and other things that were constraining competitiveness, the high labor costs, for example. But that's where countries, need to think about it. If we need to compete with other global producers who are more competitive, and our exchange rate is not an instrument that is going to allow for us to improve competitiveness, what are our options? But I think so far there seems to be a fair amount of consensus that the regimes have worked. They have the cushions of the wealth fund, of the large reserves, which Ziad is right, have fallen a little bit, but they're still big. So if you have the cushion to protect your currency peg, so they've got conditions that are still conducive to holding on to the peg.
I want to make sure we get to all the questions, but I would encourage anyone that has follow-up questions about currency pegs to come up at the end of the event and test our panelists with some additional questions. Yes, right here.
I was wondering if you could talk a little bit about the role of tourism in economic diversification, specifically some of the different models that the Gulf states seem to be taking, and what the pitfalls of that are. Obviously, Dubai has been successful in part in drawing tourists, and Abu Dhabi, and I would say probably Qatar to a lesser extent, but with countries like Oman and then NEOM, which I know you mentioned, Dr. Daoud, what are the pitfalls there? How does that play out? And is that a good model for building diversification?
I mean, that links well to the currency, because when Sona talking about some sectors job, probably getting hurt by the currency peg. When people talk in Dubai talk about tourism, they say one of the reasons why there is sort of a slowdown in tourism is because of the currency peg making, dollar rise making Dubai more expensive. There has been a drive, across the board. So what is happening in the region is that the governments would typically hire consultants, and the consultants would give them sectors to expand into, away from oil and gas. And the typical sectors, tourism is always one, financial services another, petrochemicals is one, and logistics is another. So tourism is always central. And Dubai has been, ahead of everyone else, decided to do what it wanted to do, and it's attracting the, tourists that go to Dubai. What I feel is that the rest are trying to be Dubai, but. So I remember at some point, Qatar was trying to attract the more conservative but affluent tourists. So, you go to Dubai for the stuff, and then you go to Doha for other things. Abu Dhabi is doing, the cultural stuff. The big mosque, the amazing Louvre, and so on. And Oman obviously has got the beautiful nature, etc. Now, that is helpful. Is that going to be driving? Is that going to be replacing oil? No. Is it a helpful sector? Yes, absolutely, yeah. But then the other thing is, I think tourism and other sectors, the region will be probably cannibalizing each other. So, people are not going to go to Oman for a week, and Dubai for a week, and Abu Dhabi for a week, and Saudi for a week. They're probably just, instead of spending a whole week in Dubai, they're going to spend a week in Dubai, 1 week in Abu Dhabi, and a week, 5 days in Dubai, 1 day in Abu Dhabi, and 1 day in Oman. So there is also a limit to growth if everyone's trying to do that.
So what I like about tourism, at some point I was talking to our growth experts about what are the next sectors for Saudi. What can we advise them in terms of priority sectors? Because they keep asking us this question, what sectors should we support? And tourism came up as one of them. And the main reason is, its labor-intensive nature. Now, the point is, what is the quality of jobs that can be created? Will Saudi nationals want those jobs? But I see tourism, for example, in Saudi, being a very big area for them of priority. They have a tourism plan. They've just announced their visa, I believe, the tourist visa, and the whole development of the coasts is going to be linked to tourism. Outside of the very flourishing religious tourism, the Hedge market that they already have. So, to me, I think it's a promising sector. There are the issues of, if everybody is doing this, how do they differentiate? Again, issues that other countries have faced, but I do see that as a promising sector for many reasons.
Great. Other questions? Yes, in the back.
Yeah, thank you. I think that there's a widespread perception that the UAE has done, at least so far, a lot better at diversification than the other countries. Can you talk a little bit more about whether that perception is accurate, and to the extent that it is, what explains it, and what lessons does the UAE's record in this regard have for the other countries in the region? Thank you.
Well, I think the typical sort of success story and example is Dubai, which sort of was running out of oil, decided to, go and diversify the economy, go into certain sectors, services, tourism. They had to change the values associated, it had to actually adapt its values to that, and it made difficult decisions and had the many free zones. And that seems to have works as partly good policy making, but it's also partly the fact that oil was running out already. And what Dubai decided to do is decide to be a hub for the region. So, it's decided to be a trade hub. It decided to be a services hub, financial and other professional services, and it decided to be a tourism hub and real estate hub. Now, you might be diversified in the sense that you don't sell oil and gas products. But the issue with that model is that your customers and your clients, their main income comes from oil and gas. So when you get a slump in oil and gas prices, yes, your income does not get directly impacted by this, but your customers' income get directly impacted by this, and therefore demand for your products fall. And we see that, Dubai is not immune to the ups and downs of oil prices. So the lesson is you may be able to, go one step away from oil and gas, but you're still going to be close, and you're still going to be, it's inevitable that geography will have a role. The other lesson is what we talked about in terms of tourism, is how many hubs do you need in the region? Part of what Dubai does is having a big port. Yes, Oman is doing one, and Saudi is doing one, and Neom. How many mega ports do you want? It has a mega airport there, and as a connection point between Asia and Europe. Doha is trying to do the same thing, but how many mega airports do you need in that small space of land? Tourism we've talked about already. So I think there is a limit of scaling that across the whole of the Gulf, being a hub for, everyone is a hub for everyone, doesn't make any sense. But also the fact that, if you're constrained by geography and your clients are, people around you whose income is dependent on oil and gas, you're still going to be impacted by the ups and downs in oil prices, but maybe less than before.
Yeah, I think Ziad lives in Dubai, so he knows more. But when I think of diversified UAE, I think Dubai, right? Because Abu Dhabi is still very oil dependent, and the other Emirates are not anywhere near where Dubai is. So.
All right. Other questions?
So I'm going to go back, Ziad, and Sona as well, to something you said earlier, that to make this transformation, Dubai made some difficult political decisions, and that the social contract that underlies the Gulf states is one of the main drags on diversification. Can you elaborate on that a bit? And maybe for Sona, as the World Bank is looking at advising Gulf governments on how to diversify, how can Gulf governments begin to, other than creating free zones, how do you change that social contract in a way that will be economically possible in the future, especially given the native population growth and the youth bulges in most of these countries?
Yeah, so the social contract is fairly clear. The government sells oil distributed to citizens through, distributes the income to citizens through public sector jobs, and through allowing local monopolies to exist. And that hits the labor market. It basically makes, if you're a citizen, it means if you're a citizen, you're guaranteed a job, you're guaranteed promotion, unless you do something really, bad. And that basically creates incentives for not working hard, and we see that in the survey. Now, if you try to change that, if you try to change one side of the equation by telling people, you have to work hard, and if you don't work hard, you lose your job. You're not guaranteed to find a job. Oh, and by the way, we may tax you as well, either through a consumption tax like the value-added tax, or through other form of taxation. Then maybe the other side of the social contract, which is basically, we allow you to, we don't have a say in how the country is run, at least not directly, may have to change as well. And people in the Gulf, they know that stuff. I mean, it doesn't require us to tell them what is happening. They are aware of it. They are they're completely aware of this thing. But also part of the awareness is they know that it's a difficult decision to make, and if they don't have to make it now, they could just delay it. And I think that is what's happening right now. If we don't have to make this difficult decision, then maybe let's just wait a couple of years, 3 years, and maybe oil prices will recover, and maybe we could sustain the current model. I think there is an understanding that the current model in the long term, whatever long term means, will have to change, but hopefully the person in charge doesn't have to change it here and now.
So I think a lot of the work we do at the bank is helping these governments think through how to change their social contracts. It's actually at the root of everything they're doing. And this whole vision 2030 in Saudi Arabia is that. It's how do we change the social contract in a way where we still, have a society that has a high level of welfare, but not so dependent on the state and not so dependent on oil. So some of the things we're doing, in this area is a lot of advice on labor market policy. As Ziad mentioned, they have all of these levies and quotas in order to increase nationalization of the workforce. But they're seeing backlash effects in terms of departing expatriates, lower growth, et cetera. So what is, an optimum balance between trying to meet those type of goals of providing jobs versus ensuring that the economy doesn't get depressed? So much micro work in that area. A lot of micro work on social protection. For the first time, I've seen the Saudi labor household sector surveys being done regularly, the data being shared, at least in an aggregate level, and we're in dialogue with them to try to figure out how do you revamp the social protection policy so that it looks a little more like what you see in other countries. The other big thing I think that's happening, which is also a trend that the governments are reacting to, is the massive demographic change in terms of the high level of youth who are looking for jobs. I don't think the typical GCC young population is happy with a handout or the kind of lifestyle that the parents and grandparents had. And when I visit the region now, I see more and more young people and more women in jobs that I don't think they had 5 years ago. So you're seeing an innate change just in the way the youth and the citizens are thinking in terms of wanting to have a more normal life, which is also pushing the governments to think about, okay, can we change the social contract?
Great. All right, one last opportunity for any questions. Okay, Varsha. Yeah.
I'd like to ask for your views on borrowing trends in the Gulf, which both of you had briefly touched on earlier. We've heard a lot of warning already for Bahrain and Oman, but I don't think as much for the other GCC states. So I'm curious, in your view, how much longer can they continue tapping debt markets to plug fiscal deficits before it starts to become problematic or more unsustainable?
Happy to do that. I think the Gulf states are not one. The different Gulf states have different strengths and weaknesses. I think you could classify, broadly speaking, the GCC into sort of 2.5 categories. One is the strong GCC, strong in terms of balance sheet, and that includes the United Arab Emirates, that includes Kuwait, and that includes Qatar. These guys have large savings. Some of them are not even running deficits. And the debt level is relatively low, and these guys can last for decades with current oil prices. Then you have the weaker ones, and you have Bahrain and Oman. And Bahrain already has sought assistance from its neighbors, and there's a $10 billion package from the other GCC to Bahrain. So clearly there is support there. Which could help it basically access markets and so on. So as long as there is that line of support, I think it will be able to access that market, especially given its size as well. You have Oman, and Oman, the debt dynamics are not great. As I said, public debt grew, tenfold in the last 5 years as a percent of GDP, and it's an issue. So it's a question mark. And in between the strong ones and the weak ones is sort of Saudi Arabia in the middle. It doesn't quite have the strong balance sheet of Kuwait, the UAE, or Qatar, but it's not as weak as Oman or Bahrain. And it's also Saudi is sizable and big. So far, it seems there's huge appetite for Saudi Arabia in the markets. We've seen it even with the bond issuance in January. We've seen it with the Aramco issuance. So it's more, I think, of a medium-term issue rather than, this year or next year.
Yeah, I would tend to agree with that. If you look globally at debt markets and the countries that are issuing, some of the countries in the Gulf certainly have the cushions and the creditworthiness to continue to issue.
All right, we still have another few minutes if there are any more. If not, I'll ask one last question. Let me take a shot. We still have some hands back there, yep, in the back.
I'm wondering if any of you want to share any insights on the impact of Chinese investments in GCC countries, the impacts of investments on their diversification efforts, especially under the Belt and Road Initiative. Because I think China is playing a complex role because it's buying oil from Saudi Arabia, and also it has kind of the projects like economic zone in Oman and also solar energy projects in Saudi Arabia. So I'm wondering if China is playing a positive or negative role in this process, and do the local governments welcome such help or like investments from China? Thank you.
I'll probably say two things. Neither of it is insightful. One is obviously China is a big destination for oil and gas in the region. So a lot of the exports would head east to Asia, and China is a big, trading partner in that. The second thing is quite noticeable. Being in Dubai, is there's more Chinese tourists going to Dubai around the Chinese New Year. Dubai was just very Chinese, and I think there is, people welcome that. I think is a good thing. They realize it's a market that is large and worth tapping. And obviously for countries like Oman, like all of them, but especially Oman, which is, foreign direct investment is helpful. Having Chinese capital is actually quite useful. So I think they would like more economic connection with China. Yes.
Yeah, we've looked at the Belt and Road Initiative with regard to Kuwait, where they're trying to build this Silk City, the Al Harir project. I don't know if you've heard of it. And there, it's clear that that country is really welcoming Chinese investment and trying to figure out the best way to have a win-win outcome. Again, some of what these countries are doing is risky. Ziad talked about multiple ports and multiple zones in the region. But clearly, this is one way that they see themselves as diversifying and growing. So for a country like Kuwait, to be able to have a deal with China where they can build this Silk City, in a manner that has returns to both, seems to be a very attractive proposition. So so from that angle, I did look at certainly the Kuwait-China relationship and how they're supporting them in the region with their fairly risky bets.
I would just add, too, there's been a substantial amount of Chinese investments in special economic zones, and Ziad alluded to them earlier, and I think you mentioned in your comments about Duqm in Oman. There was about $10.7 billion that the Chinese were supposed to invest in Duqm. I don't think all of that has materialized, but there are a lot of expectations there. Kizad, the Khalifa Industrial Zone in Abu Dhabi, also has received billions of dollars of Chinese investments. And Dubai is increasingly playing a role, not only in terms of Chinese visitors and investment in Dubai, but also Dubai policymakers and officials going to China. So Sheikh Mohammed was part of the second Belt and Road Initiative conference earlier this year. And I think following that conference, he announced $3.4 billion of investments or along those lines. And one of those investments included a warehousing and logistics plant. So, this all plays very well into the larger Belt and Road Initiative and the Chinese strategy of expansion that makes its way across the Middle East and into other markets. Yes, in the back, Tom.
Thanks very much. Based on the panelists' discussions with policymakers in the region, I'm curious as to where they see the biggest bottleneck to making progress on this diversification agenda. Is it lack of agreement on how to diversify, or is it lack of a sense of urgency and, I guess, energy from policymakers, or is the required policies clear and the sense of urgency there, but the political economy problems are just too great to make progress? Or perhaps there's some other bottleneck which I'm not thinking of. Thank you.
Would you like to start this one?
I can start, yeah. So I don't see a lack of urgency. I mean, again, this is, our dialogue and discussions, the fact that they keep us on our toes. We have plenty of questions and plenty of work related to this broader issue of diversification. So I don't see a lack of urgency. Again, that can turn around and if oil prices go north, because we've seen that cycle before. But right now, in the last couple of years that I've been working with these countries, there's certainly urgency. Lack of agreement, a little bit, because as you get into the details and you figure out what needs to be done, there are clearly vested interests, not just within government, but also in the broader private sector and the civil society. So the moment you start getting into the nitty-gritties, that's when this issue of lack of agreement comes around. And I'll talk to the issue of the subsidy removal that Ziad mentioned, where very ambitious plans were, laid out, and these have kind of stalled. So that, and then that relates to your third issue of the political economy, because very often when it's clear what's at stake, just like in many other countries, then they need to step back and reflect and course correct. So I do see that if the low oil price cycle continues, that the urgency will kind of become more predominant, and we'll see hopefully a little more movement going forward.
Yeah, I'll be very brief. It's the political economy. When they speak to you, they know exactly what needs to be done, and they tell you there's no diversification without changing the social contract. So basically, that's the issue. And it's not up to them to change the social contract. It's much bigger. It's a decision that goes to the very top. So that's the difficulty.
Great. Well, I'd like to bring it to a close now, but I encourage anyone that has some additional questions. The panelists will be up here. Please come up and ask any other questions or have a more informal chat. Thank you once again for joining us. Be sure to check out the AGSIW events page. We have future events coming up later this month. We hope to see many of you there and at the other events. So have a great week, and thank you again for coming.